Very pleased to welcome back to the show. I've got John Johnston here. This is a guy who's set us straight on so many different directions. He's the chief strategist of Davis Rea, joining us now on the line. First of all, John, Happy New Year. Glad you're with us.
Happy New Year to you, Michael. Thanks for having me, and Happy New Year to everybody out there.
Well, you know, and it's hard not to start the year the way we finished. People are talking about Donald Trump. I mean, he's been brilliant the way he manipulates and controls the media, and nowhere more so when it comes to some of these economic pronouncements that Mike Levy and I were just chatting about a few minutes ago, but in a new tweet, a new announcement, that kind of stuff. Let me just get your perspective on what we can expect as Canadians.
I think it's wide open. What we can expect, but I'm quite apprehensive as we move into this. I think that there's a number of things he's going to do that I would view as quite constructive. One of the things that I've looked at for a long time is how messed up the U.S. tax system is. And I've watched our political leaders and a lot of economists in Canada patting ourselves on the back about what we've done with our taxes. But now that the U.S. is going into a tax reform, that's going to put a lot of competitive pressure on Canada. I think there's elements of his tax reform package that concern me with their regressiveness, but the fact of the matter is cleaning up the corporate tax system, closing loopholes, and what he's doing at the higher end of this spectrum is going to put a lot of pressure on us in terms of competitiveness and the ability to compete for talented individuals and entrepreneurs. So I think that's a major risk for Canada going forward. We've been moving in the opposite direction after having done so much through the Mulroney and Chrétien administrations in terms of cleaning up our tax system. It's been going the opposite way, really, since Paul Martin left office. So I think that's an issue. I think the fiscal stimulus, if it comes through down there, will give the U.S. economy a lift. That will pull Canada along a little bit. I'm worried that there'll be a lot of Buy American components to that as part of his overall trade message. So it may not do much for Canada, but I think the direction on that is positive, but I don't think it's going to be all that significant. What worries me tremendously is what he's talking about doing on the trade front. And part of that is he's got part of his tax reform, which is related to trade, is this cross-border tax issue. I've read a number of reports on it, and it's basically the equivalent of tariffs. And I'm concerned that he's being very hawkish on the trade side, and as a small trading nation, Canada's going to get sideswiped. And I think there's a risk here that things turn out fairly badly for Canada, and the Canadian dollar ends up getting beaten up quite badly. Not something I'm worried about in the next 6 months, but it's certainly something that I'm watching for every day to see how it turns. And I'm surprised at how complacent Canadians are in this. When you have these big powers jockeying for position and nattering on trade, little guys like us are going to get squashed if we're not careful. And I don't know that there's much we can do about it, but I certainly think from an investing point of view is I see that as something that could affect my portfolio or clients' portfolios very badly, and I want to be prepared for it.
Well, let me just add, you just mentioned how complacent we are. I think we're number one. I've been saying that for a number of years, that Canadians are incredibly complacent about their prosperity. Ask people in Alberta how that's worked out, when the oil prices were high, and now obviously they're not, and there's been tremendous hardship there. But the other thing is, I'm going to add one more word, and this is me saying, not you, John. You can comment if you want or move on. But I'm not convinced of the competence of the people who are making these decisions. I look at all three levels of government. I don't look just at the federal, but if you want to look at our tax burden, you've got to look at what's happened municipally, provincially, federally. You've got to look at the regulatory burden there. I think we have some premiers working aggressively against economic growth, incredibly ignorant or complacent about how fragile things are, as you've just alluded to. We can get some changes here that are going to absolutely sideswipe us. The fact about tax competitiveness, as you've just alluded to, is we seem to be completely oblivious on the political front on that, at least for a huge proportion of it. I mean, we get Burger King moving their offices into, for taking over Tim Hortons, but they moved to Canada. People don't seem to get that's a positive for us, or any other capital that we attract. Yeah, I'm very worried about these things. We can't afford any more disruptions to our economy. I mean, it's not like we're chugging along. 2016 basically produced no full-time jobs. Statistical error almost in terms of size. So, yeah, I'm worried about that stuff.
Yeah, I agree with you. And on the political side, I don't think our leaders get it. We have two, the layers of government are going at cross purposes. And if you really want to be depressed about the layers of government, you should be in Ontario. The last provincial election was like a contest between Curly, Larry, and Moe, and it doesn't look like the next one is going to be any better. So I am quite discouraged. And, also kind of related to this vulnerability is economies that end up with too much of their economic activity in the form of finance and real estate and residential construction end up being very vulnerable. We've got a friend of mine likes to call the whole housing as sandcastles. That's not productive capital. You need a place to live, and it's good to have a population that's well housed. I think it's essential, but it's not something that generates economic returns over the longer run. It creates a short-term lift, and we have an economy that's overweighted housing and overweighted finance. And I think that what we saw in the United States was when that reverses, it's going to be really nasty, and that's out there for Canada. Once again, it's something we've talked about before. What's the trigger? I don't think we're going to get a big interest rate increase that's going to cause that. In fact, I think I'm still in the low interest rate camp for Canada, but it's going to be some form of external shock that lays Canada to waste, much like has happened in Alberta.
But we're not prepared for it. We don't even seem to think that's possible, and yet we've got all this evidence, as you just alluded to. Look at Alberta. What they were preparing. I've been very aggressive, John, about. I'm really a nice, polite man. But, it's time to take a stand, and we can't afford this level of incompetence. Ontario is a wonderful example of that. My goodness gracious, we have decided that a non-merit-based election of people is okay. Well, we're going to face the consequences. But one of them is we're not ready for any global change, any global shocks, and it might be brought by Donald Trump and a more aggressive trade move than even negative people are anticipating here, but we don't know where it goes. Maybe it's a China debt problem, etc. My point is we can't afford this any longer. We can't afford bad policies. And as you say, we've got three levels of government all running in different directions, and it's rarely talked about. I said on a comment this week, I said, I'll know when Prime Minister Trudeau is getting serious when he takes Kathleen Wynne to task. Because he should be, if you care about the economy. Otherwise, it's just gums flapping.
Yeah. Well, one of the things that, I observe is that, over most democracies don't do anything until they have a crisis. There's not enough consensus for action until there's a crisis. And, we saw that in the early 90s. We had a crisis. And, the governments at all levels responded quite constructively, and that laid the groundwork for a pretty good 10-year period, which then got extended by the housing lift that we got through the 2000s and the commodity boom. I just wanted to tie something back to you, just kind of wanted to share something. It relates to the quote you talked about with climate science. In many ways, I'm finding the same kind of thing is happening in economics, in macroeconomics. Other areas of economics do really well, and they're well established, and they contribute a lot. But in macroeconomics, if you worry about debt and you start talking about this stuff, you tend to be treated as a bit of a pariah. Yeah. It's not mathematically elegant, and I certainly find talking to people that if I express these negative views, I get called, basically I get a really hostile response. You're one of the few people I can talk to where I don't get a big blowback that I'm being a traitor to the country.
Well, I was giving an example earlier on today of how this has spread to the U.S. universities, exactly that. Michigan Center for Innovation and Economic Prosperity, Ross Emmett is the director there. He was targeted because he brought students together to discuss competing political economy ideas. That's how far that attitude has expanded, but I think you're absolutely right. Unfortunately, there are real consequences to the math. There are real consequences to these changes. I'm going to talk further with John Johnston, chief strategist for Davis Rea, but I'll talk about then his outlook for the Canadian dollar. He's been exceptional in looking at where the dollar is going. What does it mean for different kind of sectors in your investment portfolio? All of that coming your way. Stay with us right here on the Chorus Radio Network. Coming up, I'll give you an update on two shocking stats that we followed last year. You'll still be shocked, but I wanted to give you the latest numbers on those ones. I've also got a good Goofy Award for you. Victor Adair on deck at the trading desk, and Ozzie Jurek on the latest in real estate numbers. But right now, very pleased to have with me John Johnston, Chief Strategist, Davis Rea. John, just before the break, I think you set out beautifully what's going on in the world. I want to just come to some statistics now. What about the Canadian dollar? What are you looking at?
Well, just to kind of tie in what we were talking about before, I have a very negative long-term view on the Canadian dollar for all the things we talked about, and that still stands. However, I'm starting to feel like a bit of an outlier here in the short run, where I'm maybe a little more optimistic than the consensus. What I see happening is after, about a 2-year period where global growth was downshifting and U.S. growth and Canadian growth were struggling a bit, we're seeing a nice rebound in economic growth amongst most major economies, and the global economy is perking up nicely. And this is something that dates back to the summer. And it seems to be gaining some steam now. And that's an environment that's pretty constructive for commodity prices, especially with firms and producers adjusting their supply side. We've certainly seen that in the oil market, but we're seeing it in a range of markets. So I see a reasonably constructive outlook here for commodity prices. And that commodity price trends have been generally a pretty key driver of the Canadian dollar. They were certainly behind the big collapse in the Canadian dollar last year down to 68 cents, and they were a key driver that took us from 68 back up to 80 cents. Now, monetary policy is obviously also important, and that's something that's weighing on the Canadian dollar now, even though commodity prices are becoming more supportive. But I think that adjustment, as the market builds in a bit more in the way of Fed interest rate increases, and against the backdrop of a steady Bank of Canada, I think that effect is probably in many ways flowing through the system now and maybe behind us. So I guess my near-term bias is that I may be wrong about monetary policy and it may weigh on the Canadian dollar a bit. So maybe on a 1 to 2 month view, I think we could see some more softness, but I wouldn't be surprised to see the Canadian dollar stronger 6 months from now than it is now, maybe back up towards the 80-cent mark.
Let me just go, you just mentioned interest rates, and let's sum up quickly. U.S. and Canada, we saw a big move in U.S. bond yields that we've been chronicling here on Money Talks with Victor, and I sort of have been saying myself, this is the end of the 5,000-year lows in interest rates in the States in these bonds. What do you think there, and then what do you think about Canada?
I certainly, if we have a recession sometime in the next year or two, which is possible, we'll hit new lows in interest rates. So that 35-year bull market may not be over.
But in Canada, you're saying?
Yeah,
in Canada.
In Canada, I would say that probably a similar pattern. One of the things that I found looking back at really long-term trends in interest rates, and you talk about 5,000 years, it's kind of impressive that we have that much data that we can look at it. But the peak in interest rates tends to be a bit of a spike peak. So you get a parabolic rise and then it collapses. But the bottoms in interest rates tend to be very saucer-shaped. So I certainly think we're near the low, and, the next 3 years is probably more upside than downside on interest rates. But when I look around at the amount of private sector debt in the world, particularly amongst a lot of these corporates in the emerging markets that are looking a bit vulnerable here, I'm not inclined to be overly bearish on longer-term bonds. I certainly think the direction in yields can be drift higher, but I think there's a self-corrective mechanism here in place that runs some risks, and it's being exacerbated by the rise in the U.S. dollar, the surge in the U.S. dollar, in fact, because a lot of these emerging market corporate bonds have been issued in U.S. dollars and euros. So there's a lot of stress happening there, and I think it's something that we need to keep an eye on. But when I look out over the next 10 years, and the best predictor of a return on any bond for 10 years is the current yield, and the current yields are basically at really atrocious levels for an investor. And a lot of my models, even though I think the equity market's pretty expensive, they're suggesting 6 to 8% compound annual returns in equity markets, and that tells me that if you're willing to ride out the volatility, that a nice diversified equity portfolio is probably going to be the best place for you. It may not be the best time to buy right now, but you certainly will do okay over the longer term, certainly a lot better than in bonds.
We've only got about a minute left. Can you give me a couple of sectors you like, and maybe just, we won't have time to elaborate, but one or two you don't?
Well, I think as a general statement, when the economy turns up like it is, the more economically sensitive sectors, the so-called cyclicals, the resources, industrials, information technology, and consumer discretionary tend to outperform the defensives, which would be utilities, telecommunications, and healthcare. I think that I think the resources look quite good, particularly energy. And I think the industrials will benefit if there's any kind of infrastructure package. And I think the defensives, mainly the bond equivalents like utilities and in Canada telcos, are going to be. I certainly think that they run the risk of facing some upward drift in the yields. In terms of the U.S., I really like the information technology sector. I think the financials in the U.S. will do better. I'm not big on this interest rate margin argument. People are making that spreads are going to move in banks' favor, but the deregulation side will help them along a bit, and we're seeing more borrowing. So I think the U.S. financials, and even though it's a defensive, I think there's a long-term case here for healthcare. It's been really beaten up. And in an environment where there's this ferocious sector rotation that we've been seeing, buying the beaten-up sectors tends to pay off over time, and I think that there's an opportunity coming in healthcare. And there's a lot of uncertainty about what the Trump administration will do, but I'm watching the market to tell me when investors think it's time to go, and I think we could get a really good run in the healthcare sector in the U.S.
I gotta leave it at that, John. Time has run out. I appreciate so much you taking the time. As you can see why I love to hear from John Johnston. He's Chief Strategist, Davis Rea.